If you're planning to retire abroad, health coverage is the line item that can make your budget bulletproof, or blow it up. Today I'll walk you through typical insurance costs for 3 retiree favorites, Portugal, Mexico, and Thailand, so you can see how much you might pay each month, what drives the price up or down, and how to choose a smart, visa-compliant plan without overbuying. I'll use US dollars for easy comparison and assume a non-smoking retiree in their 60s or early 70s. Your numbers will vary with health history, deductibles, and residence status, but the patterns are predictable, and that's what matters for planning. If you're serious about building a confident plan for care overseas, grab my Retiree Insurance Decision Pack. It's free, and it includes checklists, comparison criteria, and a quote tracking sheet. You'll find it with other useful resources in the description. And if you find this helpful, like and subscribe for the rest of the Healthcare Abroad series. What actually drives your price? Insurance pricing looks complicated until you break it down into a handful of levers. The first lever is age banding. Insurers price in brackets: 55 to 59, 60 to 64, 65 to 69, 70 to 74, and the step up at each band can be meaningful. Second is underwriting. If you have pre-existing conditions, say controlled hypertension, type 2 diabetes, or a prior cardiac event, you might see exclusions, waiting periods, or simply higher premiums. In some markets, late entry applicants can face outright declines on certain plan types. Third is the benefit scope. Plans that include inpatient plus outpatient, brand-name drugs, rehab, and mental health will cost more than inpatient-only hospitalization cover. Add-ons like dental, vision, or maternity, rarely relevant for retirees, push costs higher, as do low deductibles. Fourth is network strategy. Local private plans with narrow networks are often more affordable than global expat plans that cover you in multiple regions or back in North America. Fifth is visa compliance. Some visas demand minimum coverage levels or specific benefits like a $100,000 medical cover or medical evacuation. When a visa requires it, you buy it, even if a lighter plan might suit your risk profile. Finally, there's public versus private. Where residents can access public systems affordably, Portugal is the classic example. Many retirees pair a modest private plan, or even just self-pay for outpatient, with the public system as a safety net, in places where foreigners can't easily join public coverage. Thailand comes to mind. Private insurance or cash pay becomes the default. Portugal, public backbone, private speed. Portugal is the best reminder that place matters as much as policy. As a resident, you can enroll in the public system, the SNS, which offers low out-of-pocket costs and broad national coverage. The trade-off is wait times for non-urgent procedures. Many retirees, especially in Lisbon, Porto, and the Algarve, add a private policy primarily to shorten queues and choose specialists. What should you budget? For a healthy 60 to 65-year-old retiree, local private hospital plans with inpatient and basic outpatient care often land in a modest monthly range when you accept a deductible and use in-network clinics. Premiums rise for richer outpatient, lower deductibles, and higher age bands, especially 70+, and underwriting can bring exclusions for chronic conditions. Prescription drugs are partially subsidized via the public system. If you're enrolled and your medications are on the formulary, routine costs can be quite manageable compared to North America. 2 practical notes for Portugal. First, visa stage versus residence stage. Before you're fully resident, you may need private insurance or an international plan to satisfy D visa requirements. Once resident, you can register for SNS and keep a leaner private plan for speed. Second, understand waiting periods on private policies. Some benefits only kick in after 90 to 180 days, which is normal and should be planned around when scheduling elective care. Rule of thumb: Portugal is where many retirees achieve the lowest blended spend on care. Public system for depth and affordability, private policy for access. Mexico, choice between IMSS and private. Mexico gives retirees two distinct pathways. The first is the IMSS program, a public system that some foreign residents can join for an annual premium. Membership pricing is age-based, coverage is broad, but it typically comes with exclusions for certain pre-existing conditions and a network experience defined by assigned clinics and Spanish-language processes. The second pathway is private insurance, either local hospital plans or broader expat policies, which buy you faster access, English-speaking facilities in major cities, and strong private hospitals in hubs like Mexico City, Guadalajara, Mérida, Monterrey, and the Bajío. For a healthy 60 to 65-year-old, local private plans with inpatient plus limited outpatient often price in a mid-range monthly band if you accept a moderate deductible and stay in-network. As you approach 70, or if you need fuller outpatient and brand-name drug cover, expect a higher band. Many retirees choose to self-pay for basic outpatient, primary care visits, generic prescriptions, routine labs, because prices are accessible. They reserve insurance for hospitalization, imaging, and specialist procedures. Practical notes for Mexico: if you pursue IMSS, prepare for an enrollment process, documentation in Spanish, and clear expectations about which conditions are covered. If you go private, check whether your plan includes evacuation, often not, and whether there's any U.S. coverage for trips home. Many retirees prefer keeping U.S. coverage separate or using travel policies for those visits. Rule of thumb: Mexico sits in the middle of the pack on premiums, but often the lowest on cash prices for routine outpatient care. Many retirees blend private inpatient cover plus self-pay outpatient for a sweet spot. Thailand, private first, visa-driven minimums. Thailand's world-class private hospitals are a magnet for retirees. The catch is that foreigners typically can't rely on the Thai public system, so private insurance or self-pay becomes the default. If you hold or plan to renew a non-immigrant OA or certain long-stay visas, you'll encounter explicit insurance requirements, commonly including minimum inpatient cover levels, and insurers will underwrite accordingly. For a healthy 60 to 65-year-old in Thailand, private policies with inpatient and limited outpatient care often start above Mexico's entry points, reflecting Thailand's visa-driven floor and strong private hospital charges. As age and benefits increase, especially beyond 70, premiums can climb into a higher monthly band. Many retirees opt for inpatient-focused cover and pay routine outpatient care from pocket because a walk-in specialist visit, imaging, and generic medications are still affordable compared to North America. 2 key tips in Thailand. First, consider medical evacuation to a preferred regional hub if you live in smaller cities or islands. It's a modest annual add-on for the risk it removes. Second, get written clarity on direct billing and pre-authorization policies at the hospitals you plan to use. Bangkok, Phuket, and Chiang Mai facilities often have streamlined processes with major insurers. Rule of thumb: Thailand often carries the highest premiums of the 3 for 65-plus retirees seeking visa-compliant cover, but it pairs that with excellent private care and efficient patient experience. If you want apples-to-apples quotes that meet visa rules and match your health profile, I've put vetted marketplaces and providers in the description. Start there to see today's numbers and lock your assumptions. Side-by-side budgets you can start with. Let's put this into monthly planning scenarios for 3 common retiree profiles. These are illustrative ranges designed to start your budgeting conversation. You'll plug in your exact quotes afterward. Scenario A is a healthy 62-year-old, inpatient plus basic outpatient, moderate deductible, no major pre-existing conditions. In Portugal, assume a lean private plan layered over SNS, plan on a lower monthly range, plus small copays in the public system when you use it. In Mexico, a comparable private plan lands in the mid-range. If you self-pay outpatient, you might spend a little less overall than the premium suggests. In Thailand, the same profile typically hits a mid to upper range due to visa-level benefits and private hospital pricing. Scenario B is a managed condition 68-year-old, hypertension and cholesterol well controlled, wants outpatient more fully covered. Portugal remains competitive if you accept public system outpatient for routine and use private to skip queues. Your premium plus copays stay manageable. Mexico can be similar or slightly higher than Scenario A depending on outpatient riders and underwriting, still affordable, with careful plan design. Thailand moves up a notch. Expect an upper mid-range premium to keep outpatient and brand-name drugs in the package. Scenario C is a 74-year-old with a couple of pre-existing conditions who wants minimal hassle. Portugal may offer fewer private options at this age or price them higher, but using SNS for core care and keeping a targeted private plan can still produce a workable budget. Mexico private premiums rise meaningfully at 70+, and some plans impose exclusions. Plan for a higher band or choose inpatient only and cash pay outpatient. Thailand tends toward the highest premiums of the 3 at this age, with broad benefits. Many retirees keep inpatient-only cover and self-pay outpatient to contain the monthly number. To stabilize your planning, add a monthly cushion for medications and routine cash pay outpatient, modest in Portugal with the public system, accessible in Mexico, and still reasonable in Thailand, plus an annual line for evacuation if you need it. How to pay less without taking dumb risks. Start with visa compliance and your must-have benefits. If a plan doesn't meet legal or personal non-negotiables, it's not a bargain. Next, raise the deductible and target inpatient-first coverage. This alone drops premiums sharply and leaves you paying the cheapest part of care, outpatient, out of pocket at local prices. In Portugal, lean into SNS for primary care and generics, then let a light private plan buy you speed for specialist visits and elective surgery. In Mexico, compare the cost of a richer private plan against self-pay outpatient, often paying cash for routine care wins. In Thailand, make sure your plan meets visa minimums, then experiment with higher deductibles and inpatient-only designs to bring the premium back to earth. If you split time between countries or travel frequently, look at regional or international expat plans that preserve continuity of coverage and limit underwriting surprises at each move. If you're largely stationary, local private plans are usually more cost-effective. For medications, ask your doctor to localize prescriptions to common generics and learn the go-to pharmacies in your neighborhood. And keep emergency reserves. Even with insurance, deductibles, co-insurance, and non-covered items happen, a cash buffer turns an unpleasant surprise into a mild inconvenience. Paperwork, processes, and claims that get paid. Underwriting is about proof. Prepare a clean medical summary from your home physician listing diagnoses, medications, and stability dates. translate documents where needed, and keep PDF scans in a cloud folder for quick sharing. Expect waiting periods for certain benefits, and remember that pre-existing conditions may be permanently excluded or covered only after a stability window. Read this carefully before you commit. For claims, the easiest experiences share 3 traits. The hospital has direct billing with your insurer, you pre-authorize non-urgent procedures, and you keep receipts plus medical reports organized when you pay cash. Portugal's public system will issue official receipts. Mexico and Thailand private hospitals do the same. Keep everything. For renewals at older ages, consistency matters. Avoid gaps in coverage if you can. 2 admin tips most people forget. First, set up a local phone number or reliable eSIM so your insurer's portals and your bank's 2-factor codes work anywhere. It saves days of email tag. Second, maintain a short emergency card in your wallet and on your phone listing your insurer's helpline, policy number, preferred hospital, and any critical conditions. I've put a short list of vetted marketplaces and providers where you can compare quotes that satisfy visa rules, along with a simple worksheet to record them. Check the links in the description. Before we close, a quick nudge. If you're comparing Portugal, Mexico, and Thailand, don't guess. Run 2 or 3 quotes in each country and plug them into the Retiree Insurance Decision Pack. You'll see immediately which design, public plus light private, inpatient only or full private, delivers the lowest sensible spend for your health profile. You'll find the resources and recommended starting points in the description. Here's your action plan. First, download the Retiree Insurance Decision Pack and request quotes that match your visa and benefit needs in each country. Second, pick a base strategy. Portugal's public plus private speed, Mexico's private inpatient plus cash outpatient, or Thailand's visa-compliant inpatient with optional outpatient, and price it for your exact age band and health history. If this helps you get clarity, subscribe and turn on notifications. Next in the series, watch Nomad Insurance versus Expat Plans, what's actually covered, and Healthcare Abroad, the best and cheapest options for retirees. I'll see you there. And as always, check the description for the free decision pack and the trusted places to compare quotes and get covered.